Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
All right, everyone, get ready, because today we're taking a deep dive into lower middle market direct lending. You might not be familiar with this area of finance, but we'll be using this white paper from TPG as our guide. For those who don't know, they're a global asset management powerhouse. And they put this paper out on insuranceaum.com, a website for institutional investors in the insurance industry. Now I know what you're thinking. Direct lending. Sounds a little too Wall Street for me.
Well, it might sound like it, but I think you'll be surprised.
Yeah, stick with us, because what we're going to uncover today applies to anyone who's interested in business and investment. You don't have to be managing billions to benefit from these insights. In fact, one of the things that really surprised me is that lending to the biggest companies isn't always the most lucrative.
That's right. There's this whole other world out there in the lower middle market that's often overlooked. And this deep dive is all about showing why that is.
I'm definitely intrigued. But before we go any further, can we just lay some groundwork? What exactly are we talking about when we say lower middle market? And how does it differ from the upper middle market?
Sure. So think about companies as coming in all different sizes. At the lower end, you have the lower middle market, which we shorten to LMM. These are businesses that usually have under $25 million in EBITDA. EBITDA is just their earnings before you factor in things like interest, taxes, depreciation, and amortization. And then you have the next tier up, the upper middle market, or UMM, which has larger companies and bigger earnings.
Okay, that makes sense. So where does direct lending fit into all of this?
Direct lending basically means private loans. These loans often go to companies backed by private equity, and they bypass those big traditional banks.
So it's more of a direct route to funding, cutting out the middleman.
Exactly.
I can see how that would be appealing to certain companies. But what's got everyone so excited about the LMM specifically?
TPG actually lays out 5 key advantages for lenders who work in the LMM, and they're pretty compelling.
Okay, lay them on me.
All right, so the first advantage is that there's less competition, which leads to more attractive returns.
Now, that's something I can always get behind. Less competition.
Right.
But what makes the LMM less competitive than, say, the UMM?
Well, in the UMM, you often see this dual track process where companies looking for loans will shop around to different lenders. It's kind of like trying to sell a rare item. They'll often try to get the highest price by playing different buyers against each other. And this drives down the interest rates, which means lower returns for lenders.
So it becomes a race to the bottom for lenders squeezing their margins.
Yeah, exactly. But in the LMM, things are a bit different. It's less about that cutthroat competition.
Really?
Yeah. While price is still a factor, relationships and providing long-term support really matter in the LMM. It's less transactional and more about finding a lending partner who understands your business and wants to see you succeed.
So it's not just about getting the cheapest loan. It's about finding the right lender for your specific needs, especially for companies in the LMM. They might need more than just money. They might need guidance. They might need a real partner to help them navigate the challenges of growth.
That's a great point. And because the LMM is less crowded, lenders actually have more leverage. They're not just another face in the crowd. They're a valuable partner. And TPG points out in their paper that LMM consistently offers higher spreads for lenders. This basically translates to more profit for those who choose to invest in the LMM. If you look at Exhibit 2 in their paper, you can see what I'm talking about.
Okay, that's definitely starting to make sense. Less competition, stronger relationships, higher potential returns. I like it. But let's move on to that second advantage that TPG talks about. Larger opportunity, more manager alpha. Now this one seems a little counterintuitive to me. Isn't the average LMM company considered to be riskier than a larger company?
Well, That's a pretty common misconception, but the white paper points out that this view ignores the fact that there's a large portion of the LMM that this type of lending doesn't even target. We're not talking about lending to those risky startups that are still trying to figure things out.
So you're saying there's a sweet spot within the LMM, companies that are established enough to have pretty stable cash flow but still have room to grow.
Exactly. And that's where manager alpha becomes really important. Because it's not just about riding the overall marketing wave, it's about the skill of the lender to identify and select the winners, the companies that have real potential to outperform the market.
So it's about making smart bets, not just playing the odds.
It's a great way to put it.
So the LMM basically offers a bigger pool of these hidden gem companies, which gives skilled managers more room to demonstrate their expertise.
Exactly. And this goes back to what we were talking about before, the importance of building those strong relationships. Smart lenders are the ones who become trusted advisors, getting in on the ground floor of these great companies, helping them grow, and reaping the rewards along the way.
2 advantages down, and I'm already seeing the potential here, but I know there are 3 more advantages to discuss. So let's move on to number 3, lower leverage, less risk.
Okay, this one is crucial. But before we go too far, let's just make sure everyone understands what leverage actually means. Think about it like a seesaw. On one side, you have a company's debt, and on the other side, you have their earnings. If there's way more debt than earnings, that seesaw is going to be tipping precariously, which makes things much riskier.
So higher leverage means more debt relative to earnings, which basically increases the chance that things could go bad.
Yeah, you got it.
And how does the LMM measure up in terms of leverage?
Exhibits 3 and 4 in the paper show that LMM borrowers tend to have lower leverage compared to UMM borrowers. This means they generally have less debt relative to their earnings, and their earnings are usually more than enough to cover their interest payments.
So this is interesting because even if you're not directly investing in these companies, knowing about leverage is still helpful. You can use it to assess the financial health of any company, right?
Absolutely. Understanding leverage is really a fundamental concept in finance.
Got it. Okay, let's move on to advantage number 4, stronger lender protections. It sounds like the cutthroat competition in the UMM has led to some, let's say, looser lending practices.
You could say that. Yeah, TPG talks about covenant-late loans, which are really common in the UMM. Imagine you're lending money to a friend, but you don't set any ground rules. If they start having trouble paying you back, there's not much you can do, and that's basically what a covenant-light loan is.
Yikes. So if things go south, the lender is just out of luck.
Pretty much.
But it sounds like things are a bit different in the LMM.
Yeah. In the LMM, lenders often negotiate directly with borrowers, and the loans usually come with more covenants.
Covenants.
Yeah, these are essentially conditions that the borrower has to meet, like maintaining a certain level of profitability or having a certain amount of cash flow. They basically act as safeguards, helping to keep the borrower on track and giving lenders more visibility into their financial health.
So it's not just about trusting the borrower blindly. It's about having those guardrails in place, right? Having those early warning signs if things start to go off track.
Right, exactly.
But some people might argue that the fact that we see more LMM covenants defaults means there's more risk involved. How does TPG address that?
Well, they have a few counterpoints. First, just because you see fewer UMM covenant breaches doesn't necessarily mean those loans are safer. It's kind of like saying that not wearing a seatbelt makes you safer just because you won't get whiplash in an accident. It doesn't mean you're not still at risk of a more serious injury. It's just that the lack of covenants in the UMM might be masking underlying problems.
I see what you mean. Just because you don't see the warning signs doesn't mean the danger isn't there.
Exactly. And secondly, the quality of the covenants actually matters more than the quantity. LMM covenants tend to be more meaningful and specifically tailored to address the risks associated with the borrower. And this actually leads to better recovery rates for lenders if a default does happen. You can see this illustrated in Exhibit 6.
So it's not just about having any old covenants, it's about having the right ones, the ones that will actually protect the lender.
Exactly.
And it sounds like the LMM has a better track record on that front.
Yes, for sure.
Okay, what was that third point that TPG made?
Oh, right. The third point was about revolving credit lines. These are more common in the LMM, and they give lenders real-time insight into how the borrower is doing day to day. It allows them to act much faster if problems arise.
So it's about having a finger on the pulse, being a true partner, not just a distant lender.
Yes.
It's about proactive engagement, not just reacting after things have already gone wrong.
You got it.
Okay, so we've covered 4 of the 5 advantages of LMM direct lending. Less competition, more manager alpha, lower leverage, and stronger lender protections. That's a pretty compelling case so far. I'm ready to hear about that fifth and final advantage the TPG highlights.
All right, so the fifth advantage is all about diversification.
Diversification. Everyone always talks about diversification in investing. But can you remind us what it actually means and why it's so important?
Sure. It's like that old saying, don't put all your eggs in one basket. Because if you drop that basket, you lose everything. Diversification is basically about spreading your risk by investing in a bunch of different assets. So if one of them does poorly, it doesn't take your entire portfolio down with it.
Don't bet everything on one horse. Spread the risk. I get it. But how does this apply to the LMM?
Well, TPG actually argues that the UMM has a bit of a diversification problem. They point out that there's a lot of overlap in the loan portfolios of major UMM direct lenders. If you look at Exhibit 7, you'll see what I mean. So even if you invest in multiple funds, you might not be diversifying your risk as much as you think.
So you could be invested in a bunch of different funds, but they're all lending money to the same big-name companies.
Exactly. It's like having 10 different baskets, but they're all holding the same eggs.
I love that analogy. But it sounds like the LMM offers a solution to this problem.
Yes. Because there are fewer lenders per deal, and those lenders often have a more specialized focus, true diversification is actually more achievable in the LMM.
So instead of everyone crowding around the same big companies, LMM lenders are going after different niches, finding unique opportunities that others might be overlooking.
Exactly.
It's like exploring a hidden forest instead of sticking to the main road.
I like that.
You might find some rare and valuable treasures off the beaten path.
Very true.
Okay, so we've covered a lot of ground here. Let's just take a minute to recap why LMM direct lending is looking so attractive compared to the UMM.
Okay, so in a nutshell, the LMM offers the potential for higher returns because there's less competition, and there's more opportunity to develop those close relationships with borrowers. There's also potentially less risk because of the lower leverage and stronger lender protections. And you have the ability to achieve true diversification, which allows you to spread your risk more effectively.
Okay, that is a compelling case. But I remember you saying earlier that manager alpha is really important in the LMM. So what does that mean for someone who's considering investing in this space?
Basically, it means that choosing the right manager is super important. You need to find someone who has experience, expertise, and a proven track record of success, specifically in the LMM. They're the ones who can navigate this market effectively.
So you're not just picking any random LMM direct lending fund. You're really looking for a manager who knows this market inside and out. They're the ones who can identify those hidden gems, manage risk, and guide you through this journey.
That's a great way to put it.
All right, we've laid the groundwork, but there's obviously a lot more to explore here. Stay tuned for part 2 of our deep dive into lower middle market direct lending.
Sounds good. You know what's really interesting to me is how this all ties into the bigger picture of the economy.
Oh, tell me more about that.
Well, think about it. Traditional banks have become way more careful about lending, especially to smaller companies that maybe aren't as established.
Yeah, that makes sense. We see headlines all the time about banks tightening up, more regulations, more focus on risk.
Yeah.
Seems like they're less willing to take chances on those companies that might need funding the most.
Exactly. And that's created a real opportunity for other lenders to step in. We're talking about private equity firms, hedge funds, other institutional investors who are maybe willing to take on a bit more risk.
So it's like LMM direct lending is filling a gap that's been left by the banks.
Exactly.
It's like nature finding a way, right?
Yeah.
Supply and demand, always in flux.
I like that analogy. You've got all these companies that need capital to grow, and you've got all these lenders who are figuring out creative ways to provide it.
It's about spotting those opportunities, the ones that other people might be missing. That's what we do here on the Deep Dive, right? Uncovering those hidden gems of knowledge and helping our listeners see the connections.
Absolutely.
You know, one thing that's been on my mind, though, TPG makes a really good case for LMM direct lending. But they're not exactly neutral here, are they? They're major players in this market.
That's a really important point. It's always smart to think about where information is coming from.
Right, like who's saying it and what might their motivations be.
Yeah, like imagine getting restaurant recommendations from a chef who also owns a restaurant. Food might be great, but they're probably going to steer you toward their own place.
Perfect analogy. So everyone listening, remember to think critically about what you're hearing. Weigh the evidence, consider the source, come to your own conclusions.
Couldn't agree more. Don't be afraid to do your own research, explore different viewpoints. That's what makes learning fun.
Okay, so we spent a lot of time talking about the potential benefits of LMM direct lending. But no investment is without risk, right? What are some of the downsides, the things that investors should watch out for?
Yeah, that's a great point. Every investment has its own set of risks, and LMM direct lending is definitely no exception.
So what are some of those risks in this case?
Well, one of the main risks is illiquidity. These investments aren't as easy to sell quickly if you suddenly need your cash. Unlike stocks or bonds, you can't just go to the market and sell them whenever you want.
So it's more of a long-term game, not a quick flip.
Exactly. And because these are private loans, there's also less transparency. You might not have access to the same level of detailed information about the borrowers as you would in the public markets.
So due diligence is even more critical. You really need to trust the manager you're working with.
Absolutely. They're the ones doing the deep dives on these companies, making the investment decisions. You're basically betting on their ability to pick the winners and avoid the losers.
And the other thing that comes to mind is the economic cycle. We're in a pretty stable environment right now, but what happens if things take a downturn?
That's a great question. You have to remember that smaller companies can be more vulnerable to economic shocks. Their earnings can be less predictable, and they might have more trouble paying their debts if things get rough.
So there's more risk of default during a recession.
Potentially, yes.
That's something investors need to think about, how their portfolio might hold up under different economic conditions.
Exactly. And that's why it's so important for LMM lenders to have strong underwriting standards. They need to be good at assessing risk and making sure their borrowers can withstand those tough times.
So it's not just about finding those hidden gems. It's about making sure they can weather the storms.
Yeah, that's a good way to put it.
All right, we're really starting to see the bigger picture now. LMM direct lending is a complex space, full of opportunity, but also with its own unique risks.
Definitely. It's not a simple answer. You really need to understand how everything works and be comfortable with taking on some level of risk.
But it sounds like with the right approach and the right guidance, LMM direct lending could be a valuable part of a diversified portfolio.
I think so. It's definitely something to consider for anyone who's looking for alternative investment strategies.
Okay, I'm feeling pretty energized after unpacking all this information, ready to move on to the final part of our deep dive.
Let's do it.
Wow, it's amazing how much we've uncovered about this topic. We started with what seems like a pretty niche corner of finance, but it's clear that LMM direct lending connects to so many bigger ideas.
It really does. It's like peeling back the layers of an onion, right? We're seeing how all the pieces fit together.
Yeah, and what's really struck me is how much of this applies to any business decision, really, not just direct lending, like the principles of risk and return, diversification, the power of relationships, the need for good due diligence.
Absolutely. The TPG white paper really emphasizes how much the world of finance is changing all the time.
Yeah.
New opportunities and new challenges are always popping up. Those who can adapt, those who can think outside the box, they're the ones who succeed.
Like we have to be lifelong learners. You
Sure.
can't just assume you know everything. We got to stay curious, right? Stay informed and keep trying to understand how things work.
I completely agree. That's what I love about doing this show. Exploring these topics, finding those little nuggets of insight, and hopefully helping our listeners make smarter decisions.
Yeah, well said. Before we wrap up, something's been on my mind.
Oh, yeah.
Something the TPG paper didn't really address directly.
What is...
Okay, so we've talked about the potential for higher returns in LMM direct lending. But I'm wondering, what does that mean for the economy as a whole? Could this shift in how lending works have a ripple effect on businesses, investors, even everyday people like us?
That's a really interesting question. It's bringing up a whole new layer of things to consider.
Right.
Like how capital moves through the system, the role of innovation, what does it mean for job creation, economic growth?
Exactly. If more money is flowing to those LMM companies, could that be a good thing for entrepreneurship and innovation? Could it lead to a more dynamic economy? Or are there downsides we need to be thinking about?
These are really complex questions. I think it would be fascinating to dig into the research, see what the experts are saying about the long-term effects of all this.
I'm putting it on my to-do list. This is why I love these deep dives, so many new things to think about. It's like we open one door and find a whole hallway of other doors to explore.
Exactly. There's always something new to learn.
Well said. All right, listeners, we hope you've enjoyed this deep dive as much as we have. We'd love to hear your thoughts, so keep the conversation going, do your own research, and share your insights.
Yes, keep those brains buzzing.
Until next time, keep diving deep, keep asking questions, and hey, who knows, maybe this deep dive has inspired you to learn more about direct lending, like it has for me. Maybe we'll all be LMM moguls one day. Haha.